Alright, so today in advanced accounting or um, financial reporting, corporate financial reporting, we are going to look at a very important thing or a very important key thing in consolidation. We've established the fact that once a company has taken or has obtained control over another company, then that company is entitled to present its financial statement in the consolidated form. In other words, we say that the parent or the company acquiring another company, once that company has obtained control over the other company, then that company, who is the parent, is supposed to prepare consolidated financial statements. But there are exceptions or exemptions to that. There are about 4 of them or 4 conditions under which a company is not required or is not mandated to prepare consolidated financial statement, and we are going to look at that in this video. The first one is that, remember that if a parent can acquire 100%, that is wholly. So if A acquires 100% equity shares in B, that means A is acquiring every of the shares in B. Therefore, there is nothing for the non-controlling interest. So everything belongs to the parent, which is the A. We call it wholly. But anytime they are acquiring between 50 and maybe 99, then we say the parent company is acquiring partly. Is that okay? So the first exceptions or exemptions under which a parent is not allowed to prepare consolidated financial statements is that when that parent, okay, so let's say the first one is that when that parent is also owned or partly or wholly owned by another company. When that parent is partly or wholly owned by another company, then that parent company is not supposed to prepare consolidated financial statements. And I will explain what wholly and partly means. So the first one is that when the parent is wholly or partly owned. If we say wholly or partly owned, what do we mean? Let's say that A Limited acquires shares in Z Limited, and then Z Limited also went ahead and acquired a share in Y Limited. So these are 3 companies that we are looking at. Let's say A is acquiring 60% equity shares, and Z is acquiring 80% equity shares in Y. So 80 here. Can we see something over here? We can see 2 parents. Remember that A is acquiring what? Z. Z is also acquiring what? Y. In this case, we can see that Z is a parent, A is a parent. But this Z is a parent, and it is being owned by another company, which is what? An A. If that's the case, then this Z is not allowed to prepare consolidated financial statement according to this first assumption. In fact, in the books or in books, they've split the wholly and the partly. That makes it 2 points. So the first one, when parent is wholly owned by another company, and second point, when parent is partly. So in this case, we can say that it's partly owned. Company Z is partly owned. Is that okay? So therefore, the principles or the laws outlined in the corporate reporting Ifrs 10 exclude a company of this nature from preparing consolidated financial statements. Always remember. So when that company or when that parent is wholly or partly owned by another company, then we say that that company is exempted from preparing consolidated financial statements. Now the next one has to do with when the parent does not file or is not in the process of filing its financial statement with the exchange market, okay, security exchange market. Is that okay? Or security commission. Let's say security commission. Is that okay? So the second one is that we are looking at filing of financial statements. So when the parent does not file or is not in the process of filing its financial statement with the security commission, then we say that parent is not allowed to consolidate. The last one, because I've split these two, so I've made this one to be 1. I said it's 4, so I've made this one to be 1. So when you are writing and they ask for 4, remember to split it wholly and partly as 1. And the last one is when that parent does not trade. So the key word here is what? Does not trade in the exchange market or in the public exchange market. When the shares or the equity instrument of that parent is not traded on the stock exchange market, then that parent is exempted from preparing the consolidated financial statement. So these are the 4 exemptions or the 4 key assumptions under which a parent is not allowed to prepare consolidated financial statement. Let me just add this. Anytime a company wants to prepare a financial statement, there are some key steps you are supposed to follow before you can prepare a very good, or before you can answer the practical questions and be able to present it well. Remember that the first thing you are supposed to look at is what? Determining your control structure. Anytime you are presented with a question, a practical question, without a control structure, you cannot solve that question. So it's very, very important that you determine or you establish your control structure. So when you are presented with a consolidated financial, consolidated question, the first thing is to determine your control structure. So we have done with the exemptions. You want to look at the steps you pass through to prepare before you prepare your consolidated financial statement. Remember, when we say consolidated financial statement, it can be income statement, it can be statement of changes in equity, it can be the balance sheet or statement of financial position, and it can also be the cash flow. So the first one is what? You determine your control structure. You determine your control structure. After determining your control structure, then you go ahead and determine your goodwill. Because remember, Ifrs 3 says that anytime there is a business combination, it gives rise to what? Goodwill. So you have to determine your goodwill. So the next one is you prepare what we call cost of control, also known as what? Determination of what? Goodwill. So cost of control or determination of goodwill. Alright. Then the next thing you're supposed to prepare is you prepare your group consolidated retained earnings or group consolidated income surplus. So the two are the same thing. So you prepare your group consolidated retained earnings. Retained earnings. One thing you're supposed to note is that group consolidated retained earnings is an option. If the question demands consolidated income statement, then this one is an option. The group consolidated retained earnings becomes an option. But if the question is just asking you to prepare a consolidated, financial position, statement of financial position, then this one becomes what? Something you cannot do away. It becomes fixed. You are supposed to prepare it. But if the question is asking for income, you can dodge it and prepare a separate something different. But if it is, financial position, balance sheet, then you can't dodge this one, particular statement. Then the fourth one has to do with, after you've done all this, then you prepare you determine your NCI holdings. Okay, so you determine your NCI holdings. NCI. Then the last one is then you can go ahead and consolidate. So anytime you are presented with a practical consolidated question, first of all determine the control structure. Then go ahead and determine the goodwill. So the goodwill determination will come there where you look at how NCI is valued. NCI is valued using two assumptions. It's either we use the fair value or we use the proportionate of what? The net asset of the NCI or the subsidiary. So two methods. So when we come there, we look at it. And then we will look at what? The group consolidated retained earnings in the absence of income statement. And then you determine your NCI holdings. Then from there, you can prepare your consolidated financial statement. Thank you. Thank you for watching our video. Please don't forget to subscribe to our channel for more of such valuable content on all business related courses.